It might seem strange, even counterintuitive, to think of money as something that can be created or destroyed almost effortlessly, not just printed on paper, but literally conjured into being or made to vanish with nothing more than a keyboard stroke. But in today's world of global finance, especially when we talk about the US dollar, that's not only possible, it's business as usual. You see, when we talk about international trade, say between the United States and China, we're not really talking about bags of cash flying back and forth. We're not even talking about physical dollars most of the time. What's really moving is something far more abstract: digital entries, accounting relationships, and invisible promises between banks. And understanding how this works gives us a front-row seat to the invisible machinery of global capitalism. Let's walk through a scenario. Imagine a company in the United States that wants to import goods from a manufacturer in China. Maybe it's electronics or clothing or industrial components. It doesn't matter what exactly. What matters is how the payment flows. The American importer pays in US dollars, naturally. That's the currency of the transaction, but crucially, that doesn't mean boxes of dollar bills are packed up and sent across the ocean. That's not how it works. The payment is initiated digitally through a bank using reserves, clearing systems, and ledgers that span across borders. So what actually happens in that moment? The second the US company makes the payment, its bank reduces the balance in the company's account. That's the part we all understand. It looks like money is leaving the account. But here's what's more subtle and more important. That reduction doesn't just mean the account holder has less money. It means the bank itself is shrinking part of its own balance sheet. A deposit is a liability for a bank. When the bank reduces that liability, it also reduces a corresponding asset, typically a reserve or a claim it held. In essence, that deposit, the digital money we all treat as real, is destroyed. It doesn't go anywhere. It ceases to exist. At that moment, money that existed in the US banking system disappears. It no longer exists on any domestic balance sheet. It's not waiting to be redeposited elsewhere in the US system. It's simply gone. And that's not a glitch or a bug. It's exactly how things are supposed to work. Now, of course, the Chinese manufacturer still expects to be paid, so the US bank must find a way to send those dollars abroad. But again, no currency is physically shipped. Instead, the US bank reaches out to a correspondent bank, a large financial institution that has accounts and reserve relationships with banks all over the world. This correspondent bank acts like a central hub, facilitating transfers between banks that don't have direct relationships with each other. When the US bank sends the payment instructions, the correspondent bank doesn't lose or gain money either. It simply adjusts its own internal accounting. On one side, it reduces the balance it holds on behalf of the US bank. On the other side, it credits a reserve or deposit account belonging to the Chinese bank. The total balances haven't changed, just who owns what has shifted. On the Chinese side, the exporter's local commercial bank sees a US dollar credit appear. That bank, which already holds dollar reserves, either directly or through a correspondent, now books that credit as a new deposit to the exporter's account. And here's the twist. The exporter didn't receive a transfer of money from a physical vault. No dollar bills crossed the ocean. What happened is that the Chinese bank created a US dollar deposit for the exporter, backed by its reserves or claims on reserves in the global system. In accounting terms, it credited a liability, the deposit, and matched it with an asset, the reserve or claim it holds. That's it. A new US dollar has been brought into existence. That deposit is real to the exporter. They can use it, transfer it, invest it, just like any domestic deposit. But it was created offshore in China by a Chinese bank, and yet it's denominated in US dollars. This is possible because the Chinese bank holds actual US dollar reserves somewhere, often in a correspondent account at a major international bank that has direct access to the US clearing system. As long as it has those reserves backing it, the bank is able to issue dollar-denominated liabilities. That means it can create US dollars for its clients, even though it's outside the United States. This entire system is what's commonly referred to as the euro-dollar market. And just to be clear, euro dollars have nothing to do with the euro currency or with Europe specifically. The term refers to any US dollars held outside the jurisdiction of the Federal Reserve, meaning outside the US banking system. These are offshore dollars created and circulated by non-US banks, but still denominated in the global reserve currency, the USD. So, to recap, when a US importer pays for Chinese goods, dollars disappear from a US bank account, and through a chain of coordinated accounting entries, a new set of dollar deposits appears offshore, outside the reach of the Fed, but functionally identical in every way. The original dollar was destroyed, the new one was born. It's not the same dollar physically moving, it's a new liability created in another ledger, backed by reserves already in place. And this system works in reverse too. If the trade flows in the other direction, if China is buying goods or services from the US, then Chinese importers will send dollars to the American side. Their banks reduce their dollar balances and instruct the correspondent to send reserves or claims. The US bank, upon receiving the message and the reserves, increases the account balance of the American exporter. So once again, dollars are destroyed offshore and recreated in the domestic banking system. They go from being part of a Chinese bank's liabilities to being part of a US bank's liabilities, deposits in an American account. At no point did a physical dollar move. What moved were numbers, entries in ledgers, reflected through double entry accounting and backed by reserve relationships that stretch across countries and currencies. This entire process reveals something essential and often overlooked. The total global supply of US dollars doesn't necessarily expand or shrink with every trade transaction. Instead, what changes is where those dollars exist, which banks' books they appear on, and what form they take. The dollar is always in motion, not by flying across borders, but by transforming across institutions. It turns out the US dollar is not just a national currency, it's a global unit of account. It's a store of value used by corporations, governments, and banks all over the world. Not just inside the US border, but in a vast international network of interlocking ledgers. So, while Americans might think of the dollar as their currency, it's really more like the world's operating system. And the mechanics that support it, the reserve accounts, the correspondent banking networks, the offshore creation of liabilities, those are the protocols that keep the system running. In the end, international trade isn't about suitcases of money flowing between nations. It's about banks adjusting liabilities. It's about the power of double-entry bookkeeping and the global coordination of institutions that trust each other to settle claims in a currency that exists everywhere and nowhere all at once. And that's the wonder of it. US dollars don't fly, they don't sail, they don't teleport. They just shift, transform, and reappear, like a digital shadow dancing from one spreadsheet to another. That's how money moves. And in the world of fiat currencies, where the value of money comes from trust, not metal, that's all it takes. Just an entry in a ledger, a change in a database, a flicker on a screen. Creation, destruction, rebirth, all in a day's work for the dollar.
You are now relearning economics.